Sometimes the difference between a profitable strategy and an unprofitable one is the time of day it trades. Why is that? How can we determine the best time of day to take our trades, and what is it for indexes? Well, all is going to be revealed in today's episode of BTA Live called The Best Time to Day Trade Indexes. And of course, joining us today is Mr. Breakout himself, Tomas Nesnidal. Welcome, Tomas.
Thank you very much. Welcome, guys. Welcome back. I hope you're all already excited about this upcoming episode of the Index Month November Mastery, because we're going to talk about time sessions, and I think it's a good one because it's surprising how much of a difference this tiny small detail can actually make.
It does actually sound like a very small detail, but I've had a sneak peek at the slides you're going to share with us today. And you're right, it does make a very big difference. So make sure that you hang out to see all these slides that Tomas is going to prepare. And so Tomas, why do you think, this is the second one in the series, the Index Mastery series. Why did you pick it up as number 2? Is there a reason for that?
Well, first of all, I think a lot of people ask about this quite often. What time session should I use? But second, it's one of the easiest way, or let me say, one of the easiest tricks that you can pull out to really improve your index strategies results pretty fast. Because you will see, I'll show you real data, and this data are confirming that just shifting your session properly will give you better, or can give you better results right away. And that's why we are here, right? We're here to really share with you guys the fastest, easiest tips to master indexes and get better profits as soon as possible.
Yep, exactly. All right. Well, I can't wait to dig into this one today, Tomas. I'm all excited. So do you want to get started?
Yes. So first of all, hi guys, I can already see some names popping up. So great to see you again, all of you. And let's talk about best times to day trade index. What I would like to say is this topic can be pretty deep, and there are a lot of nuances, and there's a lot of depth, and of course we have limited time. So I will keep it focused on the most important part, which is also the easiest to execute very quickly right after this show. So when we talk about best time to day trade index, well, we're going to talk about indexes in general, but if we can move to the next slide, I will specifically make an example on E-mini S&P 500, because the E-mini S&P 500, it's obviously the most traded index out there. And it's also a good case study. It's a good, let's say, prototype for session rules which apply generally across all the indexes. So let's talk about times, because times can get pretty complicated with indexes in general. So to simplify it, we can really narrow down all the nuances related to timing into 3 sessions. We can move to the next slide, please. So we all probably know already about so-called RTH, regular trading hours. And regular trading hours for indexes, it's in general 8:30 a.m. the exchange time until 3:15 exchange time. If you trade indices or ETFs, it's mostly just 3 p.m. It's not 3:15 p.m., but mostly 3 p.m. Doesn't matter. This is a small, tiny detail. The point is that this is what we used to be focused on for a long time, the regular trading hours, which is also given by the history of indexes, because before 2006, this was the normal regular session, and just during the 2006-2007, exchanges started to not only introduce but to enforce pre-market, so-called pre-market trading and post-market trading, with their objective to make trading available 24 hours the whole time, of course, because it's also beneficial for them to bring more liquidity, to bring more commissions. So that was, and it was also the overall trend at that time, that all the exchanges pretty much across all markets had started to develop towards overnight pre-market and post-market data as well. So that's why since 2006, 2007, sometimes around this time, we also have these sessions called pre-market and post-market. And again, there are nuances. So this is more of a generalized explanation today, but enough of an explanation to give you better results faster. So pre-market is basically everything before the regular trading hours opening, counting from the midnight. So anything from midnight till 8:30 a.m. we generally call pre-market, and then everything after closing hours we call post-market. So 3:15 p.m. The index market, E-mini S&P, it's officially the regular trading hour session closes, and then we trade post-market. By the way, these regular trading hours are used to be determined by live pit trading. So that was, like we have 9 to 5. We know the 9 to 5. This was for traders 8:30 to 3:15, and that's how they traded on the pit. So it all started long time before electronic trading on pit trading. Now the important thing is that it really matters more and more which part you trade, because you can keep trading the RTH only, the regular trading hours, but you can also include pre-market or post-market, or you can include just one of that or both of them. Now, what will happen? How can this influence your results? Well, the truth is that it influences results way more than we think.
It's interesting. Are you going to tell us how? It's like you left us on a big cliffhanger. It's like, tell me more.
Yes, I was teasing you and waiting if somebody asks.
Yes. Well, yeah. I asked.
Yes. Good.
Yeah.
Okay, guys. So this is not difficult. We can pretty much quantify this. We can quantify it very easily. It's and again, the way I'm going to present how I quantify it, it's a simple way. I like my analysis are usually simple and very straightforward. Because to me, it's about getting what I need and getting it in the fastest, easiest way I can get it. So there are more sophisticated ways to analyze what I'm going to share with you without any doubt. The question is if I need such a depth or extension of an analysis to get what I need to get. And I'm going to present to you right now. So what I really did, and again, if you guys watch the previous episode where we were very quickly making 5-minute index strategy based on, again, data and tendencies. And if you haven't watched it yet, please go back and watch it. We did this episode last week. Then I presented some general tendencies, and I said these tendencies were built on a very simple test. I basically took an index and I asked the question, what would happen if I buy on open of every day, and then if I exit my position at the end of the day? So it just, the whole idea the whole idea was simulating kind of what happens if I trade every day, if I buy on open and exit the market at the close. And I simulated this over 15 and 3 years because we want to see tendencies long term as well as short term. Why 15 years? Because, as I said, there were significant changes happening in indexes around 2006, 2007. So anything before 2007 can be unreliable. This was a time of transition. I remember that very vividly. And anything before that can be unreliable. So this is what we did as well. And if we can get back to slides, I'll explain to you more in details, because this is the analysis we're going through today. So, the whole idea is, as I said, it's very simple. We basically take our favorite E-mini S&P. And then what happens if we simulate this buying and selling, buying at the end of the day and selling at the selling at the end of the day? What happens if we do this on the entire 15 years of history? So we have about, I think it's roughly about 3,600 days or something like that. And we will very quickly discover, first of all, that the average trade on long side would be $15 on the long side. And of course, if we do the opposite and we sell short at the beginning of the day and then cover at the end of the day, it would be the opposite, minus 15. So first of all, we can see there the whole 15 years there's been a long bias in indexes, which we're just confirming something that we can observe very quickly from data. The important thing is to ask a question: if this is still valid nowadays, if this still continues to be the truth, and also validate what the average trade could be in a shorter recent period of time, which I usually take 3 years. That's from my experience a good comparison. And if we would trade, and again, this all applies to regular trading hours, just from 8:30 till 15:15. If we do some analysis the last 3 years, we can see that the average trade has risen a bit from 15 to 20.7, which is understandable because we have higher volatility and the prices are higher as well. So that's kind of to be expected. But the overall tendency with the long bias keeps holding. And overall, we now have a pretty good idea how the regular trading to regular how the trading from regular trading opening to regular trading closing would perform. Now the question is, how would that compare with including either pre-market or post-market? And that's when the study starts getting really, really interesting, because that's when we can start revealing some surprising and very, very neat and helpful details. So we will reveal that within a minute. But before that, I just want to make sure, Andrew, that all this is clear, that I explained this whole base clearly, or might there be any questions? Let's answer them so we can move on.
Yeah, just one question here. So this 3-year study, and also I guess the 15-year study, when does it end? Because we know, we're having a different kind of experience in the index markets recently. So is that included in this data, or what's the end point of the analysis you're showing us here?
It is approximately, I finished this approximately something like 5 weeks ago. So it's very recent. Yeah. The last month, about approximately last month, has not been included, but it's very recent.
Yeah. Okay. Well, that's good to know. Thanks for clarifying. And Olga says all clear.
Okay.
Olga can't wait to see the next bit of research.
So now memorize this number, guys, because regular trading hours average trade 15.22. Now let's see what happens if we do the same analysis and we expand it a little bit. And I'm just getting ready my slides as well. And if we expand it, if we now move it towards the aftermarket, if we simply say, okay, let's now have a look what happens if we exit at night, which is the next slide.
We need a drum roll. I can't. Here we go.
Yeah. Actually, I just realized the headline is not correct. The heading, it's supposed to be RTH to midnight, but you can see it in the description of the chart. So you can see that now we can see a pretty steep change. So who remembers the original values? It's a quick test.
Put it in the chat. Do you remember what what the regular trading hours numbers were? It was 2 numbers. I'm taking notes, so I'm cheating a little bit. But
okay.
There we go. Olga got it. Olga's quick. 15 and 22.
Oh yeah, great, Olga. So what we're looking at now, it's really interesting, because if we include night we can see that we dropped from 15 to 9 on a 15 years data, which pretty much suggests that for a long time we had no action after the regular trading hours closing, which is true because I remember even 5 years ago, markets closed the regular 3:15 p.m. and then it got boring. There was not much of an activity. But it has now, if we look at last 3 years, wow, there's a significant change, and the jump is by 100%, which is a huge jump up from 22 average dollar to 43. It's a really big one. So I think this is a pretty interesting. This is a pretty interesting thing to see, that we're getting significantly higher activity after regular trading hours, and that alone already raises a very valid question, which is, okay, shall we really exit at 3:15 p.m. and doesn't matter whether you day trade or swing trade, because you still can target your exits around specific times? Or what happens if we expand our exits till later night? And obviously, what would happen last few years is that we could very likely get better results and squeeze more money from the market. But this is the aftermarket. We still have one question to answer, and this is, what would happen if we did the same test with the pre-market? And let's have a look on the next slide.
Well, before we do, I just want to show an observation in the chat from Olga, which kind of confirms what you were saying. It means that in the last 3 years, it's really worth trading after regular trading hours.
Mm-hmm. Yes.
So that's confirming what you were just saying. Yeah, there's some potential there.
Mm-hmm. Mm-hmm.
Yeah.
But so now let's think about the third scenario. We will ignore aftermarket and we will focus on the pre-market, which is pretty much we trade from the 9 to 15:15. And now the numbers are getting really terrific, because now we're jumping. And let me get back. So at the beginning, the last 15 years, we were talking about 15 average trade. Now we're talking about 37. So we're up 150, 160%. And at the beginning, just regular trading hours, we were talking about $22. Now we're talking $49 on average, which is even higher than 43, which we had before. So now we can see another really interesting scenario where we have pretty strong, easily quantifiable proof that there is a lot of activity in pre-market. And I think this makes probably the most this is probably more logical than the activity in the post-market, because a lot of pre-market really index markets are more and more tied together. And if you think about it, before the US opens, we already have Europe trading session. And before Europe, we already have Australia and Asia Pacific, right?
Yeah.
So usually, if there is something important happening in markets, some fundamental or whatever, it can be in Asia, then it pretty much moves to Europe, and then it moves to the US. And of course, to the US, the whole thing starts before the US market already opens. And this applies specifically for indexes. So we're pretty much already seeing effect of worldwide trading on the US markets in pre-market. And sometimes there can be really big movements in pre-market, really significant movements. Sometimes actually you can see bigger movements in pre-market than during the regular trading hours, especially the last few years, which again, we've proven with our 49.4 average trade. So what is it all saying? Well, if we get back to slides, and we pull out the last. It's not actually last slide, but this slide. What would you guys? What would be your conclusion of these very quantifiable, very strong and unequivocal data? What do you think, guys? Like, what would be your next step, your action?
Let's see what if we get any suggestions in the chat. I'm waiting for Olga. I'm sure Olga. I think Olga's a very fast typist, so I'm sure she's going to give us an answer very soon. But as we can see in those, sorry.
I was about to say. I was about to say. Olga is also a very, very fast learner.
Yeah. Okay. Here we go, Olga. Before regular trading, actually, let me put it up on the screen rather than just read it. Here we go. Before regular trading hours is the strongest, both on 3 and 15 years. Mm-hmm. That's one good observation. What about the overnight to regular trading hours results there? Any observations on that one? Or even the regular trading hours to regular trading hours? What do we think, guys and girls? I think that night to regular trading hours is very, very interesting, actually. Very interesting results.
Very intriguing, isn't it?
Yeah, very intriguing. I mean, there's an obvious question about volume and liquidity, which I'm sure we're going to get to in a minute, so we'll save that.
Yes.
But,
yes.
Yeah, just looking at those numbers, it's a dramatic change from 15 to 37 to 43. That's a big difference. That's almost dramatic. 3 times at the end. Yeah.
I agree. Very dramatic. Okay, so here are the conclusions that we can draw, and then I'll show you what to do with this practically. So these conclusions, I think they're self-explanatory. So obviously, a lot is happening during the night, probably way more than we ever thought. And if you go deeper into this data, you will find there's a lot of going outside of these regular trading hours. So it means that the regular trading hours are pretty much nowadays one of the weakest session to trade, and any expansion towards post-market or pre-market does already automatically offers an improvement in your results. Nevertheless, the tendency is the strongest in the pre-market, and as Olga very clearly and very correctly pointed out, there's also stability across long-term versus short-term. So this is kind of a robust, very persuasive observation. So that's where I would start. I would start focusing on the pre-market. Now, I think that data are one thing, but we always have to combine data with, first of all, common sense, and second, with some practical knowledge and practical understanding. So it's not always so black and white that starting today we will just be blindly trading from midnight till 3:15 p.m. Obviously, there's one more element to this, and that is, as you, Andrew, already mentioned, we need to trace the volume and really see what is the reasonable time to start trading. Because if you look at E-mini S&P, even nowadays, it is true that we can see a lot of movement during the night. But the truth is also that a lot of that movement can happen just 1, 2, or up to 3 hours before the market opening, where we can easily see volume over 1,000 on a 15 minutes bar, which is a very high volume indeed. So my final recommendation would be, let's use this data, let's focus on the pre-market, but then let's do this final discretionary test. When we open our charts, we scroll a couple of months, years back, and when we see in general, just by plain observation, where the movements and volume in the pre-market usually happens. And again, as I said, mostly you will see between 2 and 3 hours. And then you simply start creating strategies with using time templates or time time condition where you limit your entries, let's say starting 6 a.m. Instead of 8:30 or 5:30 or even 5 a.m. Till 3:15 p.m. And as you saw, your potential can be nearly up to, what was it, 150 to 100, almost 200. It was a very high number. I don't know, but it was more than 100. I think about 150% higher. And that actual potential that we just modeled with this test can very quickly reflect in your actual trading as well. So, for example, if you struggle with average trade in day trading, which a lot of traders they do or might struggle with day trading, well, your average trade can double just by expanding deeper into pre-market, and all of a sudden, instead of $80 on average trade on day trading strategy or breakout strategy on E-mini S&P, you can start seeing 100, 120, which I think it's all we need.
Yeah. We've got a couple of questions and comments in the chat, so maybe we should go to those now. So Olga has a question or a suggestion, maybe. What about adding both before and after regular trading hours to regular trading hours? So I guess just the overnight session. Yeah.
Absolutely. Yeah, I took it a little bit from the easiest implementation, just one of that, but of course you can combine it. Yes.
Yeah. And then the second part I didn't read. I assume average trade would be even higher, which I guess looking at the numbers, that does, very likely. Yeah. Did you do any analysis on just looking at European session times versus US?
Not yet.
Not yet?
Not yet.
All right. We got a question here from Beef. G'day, Beef. Good to see you here. This is a two-parter, actually. Would going long only be advisable? Or maybe you can answer that bit first.
Well, so first of all the numbers suggest very strongly that there is strong bias in E-mini S&P. This is one of the things I will also talk during this month of Index Mastery a little bit further in one of the upcoming episodes, but this is also something we covered in the previous episode. So if you haven't watched it yet, please watch the previous episode. But overall, there is definitely a strong long bias in E-mini S&P. And it's if you go just with long side, then you're already playing a pretty strong omnipresent bias in your favor. So yes, it's definitely a good idea.
Yeah. And the second part of that is maybe just keep short trade positions at a very small position size to reduce the risk.
Good idea. Yes.
Yeah.
That's the other way how you can play it, through position sizing. That's a good idea. Yes.
Yeah. So then something that you touched on a little bit earlier was, the data earlier in that period. I think, from 2015. Sorry, if you're looking at 15 years of data, then, as you mentioned, the earlier data is a little bit maybe unreliable. So how much do you put behind this study when you can see that maybe the data isn't that good early on? Is that a big factor, or is just something you just have to accept?
By early on, you mean before 2006 or 7?
Yeah.
I quite honestly, I totally exclude this data, and I do not work with them anymore because there's been a lot of going around 2005, 6, and 7. So first of all, during the time it was the end of pit trading, and it was a slow, pretty painful transformation from the pit trading to full electronic trading. And we used to have two simultaneous sessions. We used to have a pit trading session together with electronic session. And during 2005, 6, 7, we saw very steadily how the volume first was it was in favor of the pit session, but then it slowly started to fade out, and all the volume went to the electronic session. But there was a transition 2-3 years, and the data were really affected by it. And then once this all things started, as I said, they started to push overnight trading, and I remember there were a lot of weird stuff in data and discrepancies between the pit trading and electronic trading, and then they tried to combine it a little bit together. And the point is that whatever was happening with data and trading before 2007, especially 6, 5, these years, it's different from what we see now. So what we see now, it's a pretty stable process of how data are generated, delivered, and we're already working with something which got some more or less history of consistency. Whereas before 2007, the consistency was rather questionable. So I put very little attention on data before 2007.
Yeah, right. So I guess this data, well, actually, in your opinion, does this data suggest now that you can build or you can test and test and trade overnight specific strategies only? Like, is there enough volume? Is the data good enough that you can actually trade not just in regular hours, but specifically for overnight strategies?
It's the best we have, and
Yeah.
it's not ideal, but it's good enough to make decisions for me.
Yep. Okay.
It's not perfect, but it's good enough. It's the best we have. Yes.
Yeah. Are you trading overnight strategies now?
Yes, for
Okay.
a couple of years already. Yeah. And you know that, guys, I have to tell you, that was actually Andrew's idea to start trading overnight. Was it 4 years ago already? I think it was 4 years ago. I remember it was when I was last time in Kuala Lumpur, and it was 4 years ago. And that time you introduced this idea. So yes, I'm just following. I'm just building up on your initial research and results. That's all I do.
And I discovered it by accident, so I'm no genius, but if it works, I'm also trading overnight strategies, and they seem to work pretty well. So
yes,
yeah. Okay. So no other comments in the chat right now, Thomas. So if you want to continue on to what's the next slide? Okay. Yeah. So let me just put this.
Yeah. So we have one more slide. So this is an index mastery month, as we said, but again, we just touched the surface. There are a lot of other nuances with times. There are a lot of other edges with times that you can play in your favor really, really well. So you can get beyond this. You can improve your results even further. And we're going to have a special index mastery in December. So if you want to be part of this index mastery, which will go way deeper with some amazing tools and very precise and very mind-blowing data, then please go to gobta.com/indexes, and you can pre-register there to receive information once this index mastery is ready.
Yep. So there's no sign-up page or anything at the moment. We're still preparing things, but if you go there, we'll submit your email address. You'll get summary notes of each of the episodes as we go through them in this Index Mastery Month, and also we'll let you know when when the workshop is open. You can get some more details then. So go-bta.com/indexes. Okay. So no other comments in the chat, Thomas. So I keep thinking that we're going to do a quote of the show, but we don't do that at the moment, do we? So
we don't
tripping me up a little bit.
Yeah, there are not enough quotes about indexes to build up on. But I can tell you one quote. I can tell you guys, indexes are one of the best markets to start with and one of the best to trade because they have so many pre-built or built-in tendencies and small edges that if you combine them well together and then you apply, let's see, the Mr. Breakout's model on top of that, you can very quickly and easily create very powerful strategies. And again, this is the advantage of indexes. There are very few other markets which would have so many pre-built strong tendencies and kind of biases that we can explore and use in our favor. So if you're an index fan, you're at the right place. I'm an index fan as well, and this was just one of few other things that we're going to not even cover in the Index Master workshop, but we're going to reveal even more this month, every Tuesday until the end of November, with other episodes of the Index Mastery November. And you will be surprised, we still have quite exciting stuff to uncover.
Yeah. Well, what an excellent way to wrap up the show today, Thomas. Thanks for that summary and inspiration. So if you enjoyed the show today, please remember to give us a thumbs up and make sure you subscribe and hit the bell icon so you can be notified when we release new content. So any closing words, Thomas? Are we done? See you next week, perhaps.
Happy index trading, and see you next week.
Yep. All right. Cheers. All the best.
Thank you. Bye-bye.